could include strategy layers that diversify it. You could include products that are negatively correlated with it to diversify it. The list goes on. This gets into the notion of physical decorrelation. I don't need a backtest to tell you what's going to happen. If I observe a CAPM regression that looks like this, I do not need a backtest to tell you what's going to happen when the market crashes. Of course, assuming that there are no hedge legs or alternative sleeves in place to prevent the adverse outcome of what the portfolio is to experience during a crash. Because if I just look at this portfolio relative to the market and I look at the regression, I can say, okay, well, clearly we're overexposed to beta. During a crash or a crisis, do we have other legs in our portfolio to physically decorrelate ourselves with that crash so that we can survive or even generate more money? If we don't, then we're just going to crash terribly alongside the market. But if we do, we may even be able to not just outperform, but significantly outperform in the long run, the broader market. That's going to create better drawdowns. That's going to improve our compound annual growth rate. And that comes from this idea of physical decorrelation. When I roll a dice, if I roll another dice, they have nothing to do with each other, right? Here we just saw, because semiconductors and healthcare operate in the same market, right? US equities, they're going to experience a drawdown together. But what doesn't experience a drawdown necessarily together with US equities? Well, what if I have a watch portfolio? Then I have a watch price path, and I also have my US equity price paths. You can see during a crisis now, the watch does not care at all about US equities. That is an orthogonal risk. It's an orthogonal market. It's perpendicular. It's uncorrelated. It has nothing to do with US equities. It has nothing to do with it. So during a drawdown in US equities, we experienced the worst of this undiversifiable risk, but the watch prices, they didn't care. They didn't care at all because they're completely separate markets. They're completely separate markets. Just because US equities is taking a dive, it doesn't mean watch prices are too, right? This is an empirical question. This is, what constitutes a market of risky assets? What can we do in a particular market to maybe include negatively correlated assets or uncorrelated products with that particular portfolio, with that market exposure? And that's going to improve our diversification benefit. So in other words, by including risky assets that are a part of separate markets, you can diversify the undiversifiable risk, if you will. So essentially what I'm saying is we've observed undiversifiable risk in US equities, this broader market risk, but that's for US equities. If we can find other assets, maybe watches, maybe art, maybe real estate, whatever it may be, and include that in our portfolio as well, we can achieve a diversification benefit, improve our risk-adjusted return, improve our max drawdowns and our compound annual growth rate. And during a market crisis, we will be certainly better off holding that diversified portfolio. Okay? That doesn't mean you're just going to hold as many uncorrelated assets as possible. Remember, just because you have different risk profiles, it does not mean you're going to have a higher return profile. We talked about this way earlier on with the AI startup and Microsoft. Don't get confused. That same idea still applies here. Just because we're looking at higher risk and lower risk, or too high risks or too low risks, it doesn't mean they have comparable return profiles. If I structure a portfolio of assets that are orthogonal to one another and they generate a net zero correlation in my portfolio, and someone else does that randomly, it doesn't mean we're going to have the same expected return. That's not at all what it means. So that's this idea of physical decorrelation. How can you diversify, if you will, the undiversifiable risk? And it's by finding markets that are separate or orthogonal to whatever risky assets you have in a segment of your portfolio. So when you go about a portfolio engineering exercise, you are going to include different sleeves in your portfolio. You're going to have maybe an equity sleeve. Maybe you have a bonds sleeve. maybe art, maybe real estate, maybe watches. Who the fuck knows, right? There's no one size fits all silver bullet approach, but your risk appetite will dictate what you're holding in your portfolio. Okay. Which brings us to a very reasonable question. What should I hold in my portfolio? A better question to ask yourself is, what are my goals? You can say that your goal is, oh, I just want to maximize my wealth. And fair enough, right? But what you also have to realize is, if I say I want to maximize my bench press, then implicitly I need to work on my shoulders, my triceps. I don't get to ignore those things, right? So when you say you want to maximize your wealth, you still need to work on your shoulders and your triceps. You don't get to ignore those things, which is why I find this is a major point of confusion for your own personal portfolio construction. Some people are cool with passive management. Some people are just, okay, I'm going to buy the S&P 500 and chill for a very long time. That doesn't mean that you're going to have access to your money when you need it. What if in 6 years you need your money and there's a 30% drawdown? Now you're selling for 70 cents on the dollar. Is that cool with you? That's your shoulders and triceps. You can't ignore your shoulders and triceps because you want to build your bench press. Some people want to assume more risk to attempt to achieve more return. Some people don't care about that drawdown. Some people don't care if they have a 60-70% drawdown. They don't care at all if they need to sell for 30 cents on the dollar. I do. I care a lot. I don't want to subject myself to that volatility. That sucks. It sucks not being able to access your money. Nobody wants that state of the world where there's a 40% drawdown and you need to sell for 60 cents on the dollar. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, Quant Guild has 2 crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to Quant Guild if you're interested in these free resources.